Good morning, ladies and gentlemen, and welcome to the Grit Real Estate Income Group full year 22 results and Q&A session. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Just please simply type in your questions at any time and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company review all questions submitted today and publish responses where it's appropriate to do so. Before we begin, we'd like to submit a couple of polls. If you give those your kind attention, I'm sure that the company would be most grateful. And I'd now like to hand over to Darren Venus. Good morning, sir.
Morning. Thank you, Mark. Welcome, everybody. My name's Darren Venus, the Head of Investor Relations at Grit Real Estate. We'll hand over to Bronwyn Knight, the CEO, and Leon van Moorsel, the CFO. And we're going to sort of have a session of about half an hour of presentations, and then we'll open up for Q&A afterwards. So without further ado, let me hand over to Bronwyn.
Thanks, Darren, and welcome to everybody that is registered today. I think it's really a fantastic, time now to really take everybody through what has been achieved sort of post-COVID over the last 12 months. And both Leon and I are very, very proud to present these set of results. And I think just to really start before I get into the highlights of what's really been achieved over the last couple of months effectively. So I think, just going into really some of our significant highlights, and just to really start the presentation today on the magic and the culture of who Grit is, what we do, and why we do what we do. So I think just to maybe just start on this slide. So we have the grit to go where others fear to go. We're pioneers, people-centered, proudly African, and woman-led. We're powered by purposeful impact through authentic partnerships. We're a diverse team of spirited warriors impassioned by the challenge of developing smart, sustainable business solutions for inaccessible African territories. We help visionary pioneers in business flourish in the rugged richness of Africa. We find the way. And just to really go onto that point and really around the fundamental highlights of what has been achieved over the last couple of months. We are really impassioned by being a woman-led business. We've got some incredible stats around members of the team who proudly lead teams going into our construction and development team that we've obviously acquired through the acquisition of APDM. We have completed a building in Kenya that was proudly led by a woman development team, a woman-led team on the ground, by a program by the name of Build Her. So really when we talk about from income to impact, it's all about really highlighting the impact that this group business has made over the last couple of months. So really just around that, the impact around the economies we support, the communities we support, going into both the environment, the ESG, the social, and obviously overlaid with that through our premium London listing is obviously around the governance structure. So for us, it really has been a 12 months post-COVID that has seen some tremendous successes. It's been very, very challenging, as everybody has been aware over the what's been happening from a global market perspective. What we've seen has been tremendous from an impact perspective. And really just going into the fundamental highlights of the business operations and financial operations of Grit. And actually to start this is to say that our new home, the Precinct in Mauritius, which will be completed at the end of this year, has been awarded the first 5-star green rating in the Indian Ocean. This is a tremendous accomplishment and really is about setting global benchmarks in Africa and beyond. So we're very proud of our new home and this global benchmark. So really just fundamentally going to where did we begin, how has it been pre-COVID, during COVID, and where do we find ourselves today? So if you remember during the last results presentation, there were really 3 key themes that I focused on. One was around stabilization of operations, ensuring balance sheet enhancement, and then obviously around the significant corporate activity that took place. Again, going back to stabilized operations, and what Leon and I will take you through today is really fundamentally around the asset performance and the strength of the underlying operations run by Andries, who has really asset managed this portfolio to see improvements in vacancies, to see improvements in NOI, to ultimately see the valuation stabilizing, specifically around retail, specifically around hospitality. The hospitality assets, which I'll touch on today, which are very much open and trading, and the significant resuscitation of the tourism sector as we've seen it, the completion and the acquisition of our development company, both the development services business as well as Greer itself, really around the balance sheet enhancement, the significant reduction in LTV, the capital raise that we have completed at the beginning or the end of last year. And most of you in the audience would hopefully have seen the significant debt refinance, which is the largest syndicated sustainability-linked facility in Southern Africa. And then that goes into the asset recycling, which is a key thematic to what I will take the audience through today. And then just around the corporate activity that we've seen. So the corporate activity touches on our substructures and the successful completion of the acquisition, as I mentioned now, around the development manager and Greer, as well as establishing our Kenyan and industrial sector focused substructures, really as something that we're looking forward to into the future. Really just going on to the highlights for the 30th of June 2020. And I think the audience is very much aware of, one, the impact of COVID on real estate businesses. Secondly, the impact of what's happening globally in relation to increasing interest rates. But really, I'm very proud to say that amidst all of that, what we have been able to see is we've been able to see a growth in our underlying portfolio with just over a 6.9% valuation growth in the underlying portfolio. Remembering that the Grit portfolio, every single asset is independently valued by our external valuers. The actual operational performance, so we've seen a 3.5% growth in NOI. We've seen a take up of our vacancies and improvements in the vacancy rate. We've also seen significant take up in vacancy post balance sheet with a significant take up by one of our key tenants in Mozambique. Collection rates have obviously improved dramatically, with actually a full hospitality recovery collection, historic rentals collected to date. And then just really going into the financial metrics. So we would have seen a dilution on our EPRA NRV, but this was really impacted around the capital raise that we closed at the end of last year, which was a dilutionary capital raise. So even in the midst of that, the actual underlying portfolio, the growth of the underlying portfolio still saw a good growth in relation to NAV. We're very proud to have declared a full year dividend and the half year around 4.5%. Sorry, 4.5 cents, which I'll take you through, which is I think just over 12% return. And then obviously the significant reduction in group LTV, which goes around the balance sheet enhancement and balance sheet strength. And then, as I've mentioned earlier, is the closure of the acquisition in our development partners, both Greer and APDM. One of the key fundamentals which I mentioned to the audience at our last year results was the ability to recycle some of our assets. Now, asset recycling obviously means around assets that are non-core to our business, where the valuations ultimately have peaked or we've realized that they've reached the level on the valuation cycle. The ability to prove valuations in Africa is obviously the importance around asset recycling or disposal of assets. And to date, we had committed to 20% of the current portfolio. We have achieved around 3.5% of that to date. However, I might add that we've made significant progress actually in the up and coming months to ultimately achieve the 20% asset recycling. The benefits of that asset recycling is obviously to reduce LTV, to bring further cash into the business, and obviously, as I've mentioned, just to demonstrate valuation. So you would have seen the disposal of Absa House, We have a co-investor, being LR, that is co-invested alongside a transaction that we closed at the end of last year, Orbit Warehouse. And currently, we have put to market that we are looking at disposing retail, which is non-core to our business going forward. And Answer Place, we have stepped away from the current offer, but we are still in negotiations with potential buyers on this particular asset. But just to highlight that we do see that 20% target coming up and being reached in the up and coming months going forward. So ultimately, just as a reminder through to everybody, is that we are Pan-African. As the audience knows, we don't invest in South Africa. With our acquisition of Greer, which is Gateway Real Estate, which is the development company, we now have 59 assets in 12 territories across Africa. The importance around this, again, just to remind the audience, is that we see half of our world invested in investment-grade Africa, countries like Botswana, Mauritius, Morocco, and I obviously have to be careful around the term investment grade. But the other half of our portfolio is what we categorize into growth Africa, countries like Ghana, countries like Kenya, countries like Mozambique. But fundamentally, we are servicing the needs of global tenants, collecting hard currency rentals. And if you see from the high quality tenants and also with the acquisition of Greer, our OBO or US Embassy exposure has increased somewhat. So you'll see on this particular slide that Darren has gone to, our embassy exposure sits currently at 6.4%, but with the consolidation of the Greer business going forward, we see a significant increase in US Embassy exposure. So the Grit business servicing global tenants, hard currencies, multi-geographic, and really being able to be the real estate solution for these global tenants, as you see listed on this page now. As I mentioned earlier, the operational team has made significant strides in relation to take-up of vacancies. The operational team has really done very well. We've seen a very large recovery, which we'll touch on now in respect of retail, but you'll see that our operational sort of vacancy metric has moved quite significantly. And if we go, Darren, if you can just go through to this specific slide. So as everybody is aware, hospitality had obviously a global impact over COVID. You know, I'm very happy to announce, and you would have seen this demonstrated by the Beachcomb and Lux results, that the actual tourism numbers where we were sort of 2019 versus 2022 now, the recovery, the uptick in immersion arrivals that have happened. We, to date, have collected all of our historic rentals, and as everybody will remember, we gave COVID relief in relation to cash flow deferrals over the period of time, but everything has been collected to date in relation to the hospitality sector. Furthermore, we have announced under our recent debt facility that was led by Standard Bank that we will be doing a phase 2 to Cape Skirring, which is our Club Med Senegal asset, and there will be a phase 2 development that's completed. But from a hospitality specific side and also from a valuation specific side, we've seen huge recovery. The only noting point, sorry, just before you go off that, Darren, which Leon will touch on, is that there is these assets are reported in euros. So there has unfortunately been a euro dollar, as we've all seen globally, what the euro and dollar has. So we have, whilst we've seen valuation recovery, we've still seen the euro dollar move against us in respect of the overall valuation. So just going through, Darren, if you can go. So retail has actually had a much better recovery than we would have actually forecast and what we had forecast. The Zambian portfolio has really performed post-COVID exceptionally well. The take-up has been exceptional to see. Again, the operational team from a management perspective has done a tremendous job around these particular assets. Unfortunately, we still see Mozambique a little bit behind, but actually going on to Morocco, which is really noting point from this slide, is that the footfall that we've seen and the increase in footfall has actually been better than some of the rates that we've actually seen since owning this asset. Now, remembering that a significant amount of our tenants actually sit on turnover clauses, and the footfall is to translate, as it should do, into turnover. we have not modeled any of this upside on turnover clauses in relation to these particular leases. So retail itself, we've been very happy with the NOI recovery, which has obviously gone into the valuation recovery itself. Light industrial is obviously a key fundamental focus of the Grit and Greer going forward. You will hear me mention that we are launching an industrial substructure. This industrial side of the portfolio, with the acquisition of Orbit, which was closed at the end of last year, and a phase 2 will be completed, has really just seen some very, very good performance and continues to see resilience. We have completed the Bolloré warehouse, which you'll see here in the pictures. I think the before picture looks actually quite dismal, but it is a really great looking facility now. And we continue seeing this as impact real estate. That will be a key fundamental focus of our business going forward. Corporate accommodation, as you probably are aware, has been really one of our key fundamental focuses. Historically in Grit, and what we've seen has been done by the Greer team over the last probably 18 to 24 months. So corporate accommodation has focused on servicing the needs of American Embassy. We successfully completed through our Greer team, led by Greg, the completion of Roslyn Grove, which is the Kenyan American Embassy. Just for noting purposes, this was awarded one of the top corporate residential development awards at the recent API Awards, which the Greer team saw unbelievable accolades actually being recognized at these current awards that have gone through, and extremely well deserved. Just to remind the audience that this Greer team completed these assets over the COVID period. So these developments that you see now completed over the last 24 months have been in some of the harshest conditions that we've seen globally. So this is an unbelievable accolade that's been achieved by this team. And this is a key fundamental focus asset class, which really defines impact real estate as a focal point of the group going forward. So just to really touch around the office sector itself, whilst we have still seen some challenges in Ghana with regards to just the general rental market, we still see our tenants as being really, really strong in this particular market. Mozambique, with the significant lease that we signed post-year end, we've still seen really robust renewals and obviously activity in the operational performance of the Mozambican portfolio. And then with regards to our partner Greer, will be the launching of the Precinct, which will be one of the sort of landmark office accommodation, sort of 5-star rated assets in Mauritius, which obviously now gets completed in December of this year. And then just as a reminder around the alternate sector update. So alternate sector focus, again, goes to impact for us. So this concept of what is impact and what are we going to be focusing on. The Greer team has completed a data center for ADC in Nigeria over the last 18 months, again, over the COVID period, and that completion was absolutely significant in relation to being on time and delivered effectively for that particular tenant. The completion of a healthcare hospital facility in Mauritius, which is now going to be completed in the early part of 2023, a second hospitality asset coming up in Mauritius. So these are for us the alternate impact asset classes that we see sort of huge performance and actually focus over the up and coming months. So again, really around the focus around the leasing, focusing around the operations, focusing around the NOI stability and growth thereafter, which obviously has an impact on the valuations, and just really around the income profile and really solidifying the NOI story and just around our tenant base into the future, the absolute focus points of ourselves. So at that point, I'm going to hand over to Leon on the financial review, if he can take you through that. Thanks, Leon.
Thank you, Bronwyn. I think just a few key highlighting items that we wanted to put through before we go into the detail. Distributable earnings sitting from 597 down to 501. This has been impacted obviously by the large capital raise, which we did at the previous financial year, similarly to the EPRA adjusted earnings. But maybe just to to harp on one point is just really the property portfolio's income, which has risen by 3.5%, which is on the back of selling a few assets and then bringing on new assets which have only been operating for roughly 3 months in the financial year, which does bode well for increasing revenue in our income base into the future. One thing we've been often criticized about is the way we display our numbers. Being in Africa, where there's a strong tie between the people of Africa and real estate and property, a number of our investments are actually held in partnerships with other people or in co-ownership structures, which unfortunately, one of the pitfalls of IFRS is you often don't see the detail behind it. What we've done in the previous year and now continuing is to try and get down to a point where we can actually display the actual revenue that comes through GRIT's proportionate revenue or economic income statement, which does give you a very fair reflection of how the actual income and the costs are generated, as well as just providing the insight into the results within the associates and obviously the co-owned properties where a portion of the revenue is to our co-owners. This is a very important slide in terms of understanding the numbers, and is something that we would like to really push forward in the future to provide more deep insight into our numbers as they grow. Throughout the rest of the financial numbers, we have reconciled all of these and show them on a good proportionate income statement basis, just to provide absolute clarity into these numbers. I think the one key thing that we always need to look at is our income generating base. So during the past year, we have sold a number of assets in Absa House. We have also reduced our stake slightly in LLR, but at the same time, we've now increased our asset income producing base with the inclusion of the Orbit facility in Kenya, which became operational and income generating to us in March. We had the completion of the Bolloré warehouse redevelopment, which completed in January and handed over to the tenants during the period of February through to March. So the full year impact of these new developments and new income generating assets is not yet through the numbers completely and would be really positive in the next year. The other item to consider is just the Greer developments. A number of them have completed during the prior financial year. With our increased stake, they're now sitting at 35%, and the handover of a number of these properties during the next 6 months, starting with the DH3 housing complex, which is the OBO complex in Kenya, which was handed over at the end of August, and the completion of 2 other assets in the next 3 to 4 months, being the precinct, which is our new home as GRIT, which is shared with a number of the important international clients, including RMB, Dentons, and Workshop 17. The actual income generating base from this will increase significantly into the future. The key items to understand in these numbers as well is, although the growth does sit there, it has been fairly heavily impacted by the depreciation of the euro to the US dollar. So even having regard to that, we've had a 6.9% increase in our income producing assets. On a fair value basis, although we did see some of the sectors actually contract in total value, for example, in retail and in hospitality, which are predominantly led with euro-based assets, we did see a dollar valuation drop. However, the actual underlying valuation of the properties were growing significantly at 5.3%, showing the underpin of these recoveries in the hospitality sector. On a similar basis, in terms of the revenue and the NOI, maybe just to highlight a few items. In terms of the office, what you are seeing there is a 10% reduction in the revenues. This is as a result of the prior year period where we had a large exit fee paid by one of the tenants. I'm happy to report that space was taken up in a very difficult Ghanaian market within 3 months and having replaced that tenant. On the other side, the retail is something we're very happy with. Although this is something that has been impacted by the depreciation of the euro with regards to the Moroccan dirham, which is 60% led, we've still managed to achieve a 12.8% increase in revenue and a 21% increase in NOI. The recovery that has come through specific on the Zambian portfolio is very encouraging, as well as the recent leasing activity in Antwerp Place Mall has really placed this sector on a strong path to recovery. You'll see the hospitality assets have slightly reduced. just to highlight that that's actually a 4.1% increase in revenue in euro terms. However, it's offset by the poor performance of the euro versus the dollar. Overall, 3.3% increase in revenues and a 3.5% increase in NOI is very encouraging, specifically in the backdrop of the euro assets, which is about 25% of our portfolio at this point. Obviously, the one thing we watch quite closely is our performance in terms of NAV growth. We are encouraged by the fact that a number of developments which will be completed during the first half of 2023 will come through in the results in the next time we present. However, the predominant factors that are resulting from the decrease in our EPRA NRV has been that the equity which we issued at a discount to NAV in December. And one of the other items impacting this is the drive-in trading guarantee, where we've made significant provisions against this. And just to reiterate that this is driven predominantly to our share price performance, and hopefully we'll see some good recovery post these results in that and the reduction of these impairments that we've taken to book. I think one of the things we're particularly proud of having achieved in the last few months is the sustainability-linked debt finance arrangement, a fairly complex deal to do in Africa, where it covers a number of regions, being Mozambique, Zambia, Ghana, Senegal, as well as Mauritius. It's really highlighted the fact of strong partnerships with our financing partners, led by Standard Bank and supported by Nedbank and ABSA. This has been a key item that we've been looking for longer-term solutions. It not only gives us longer tenor in terms of the facilities, but also provides cross-collateralized assets, which reduces our cost of funding in the long term. Having an increase from our current base from 5.25% based on LIBOR to a 5.59 basis points increase over SOFR, I think in today's debt markets is a great achievement, and does bode well for the financing structures into the future. I think the key concept now is that our weighted average debt expiry now sits at a healthy 3.7 years, bearing in mind that in African property finance, it's very difficult to achieve any finance transactions greater than 5 years on an interest-only basis. One of the other items which we've been spending a lot of time on is specifically the hedging of interest rates. What we have seen over the past couple of months, starting with the Ukraine and conflict, has been the issues found around interest rates and inflation. Although inflation in our environment is not specifically the worst thing in the world, as most of our tenants are linked to CPI indexated leases. Obviously, the length and depth of this cycle in terms of interest rates is something to be concerned about. We have entered into an additional $100 million worth of notional interest rate hedges. This is going to be something that's predominantly driving down our interest rate exposure on the US dollar. As we sit today, our actual exposure in terms of US dollar floating rates is just under 25%, which does bode well for the interest rate cycle ahead of us. So one of the items which we obviously keep looking at is our LTV. And I think the big next move in LTV is once we gain full control over Greer, and which will have an impact of roughly 4% on decrease in our LTV, given the low gearing that actually exists within the Greer structure. Obviously, the other items which you do need to keep a close eye on is the weighted average cost of debt, with that going up to 7.1% right at year end. We will see the hedging coming into place and really being effective as interest rates rise, giving a very good buffer to how far that can actually go. Interest rate cover in the backdrop sitting at 1.8 after still a very difficult hospitality sector in the first 6 months of this financial year is very encouraging. You do see that our net euro position has increased to 73.8%, which is on the back of us settling some euro debt. However, these hedging contracts gives us about a $25 million hedge against that position as well. I think one of the items which has been a historic drag on the financials of the company has been the drive-in trading, black economic empowerment arrangement which we had. This is now going to be settled out in the next few months. We have made significant provisions against this, currently sitting at about $14.5 million, which come at the end of this will actually reverse a lot of those provisions and provide an upside to our shareholders in terms of the net asset value per share once we collapse the structure and take the security into our own hands. Just in terms of upcoming capital commitments, as Bronwyn mentioned earlier, the phase 2 on Club Med Senegal is about to commence. This is an exciting project with good yields, specifically in that environment. On the back of the impact this has into the community around the area is also significant and something that we're very proud to be involved with. The Orbit phase 2, which is going to really unlock the true potential of the tenant in terms of the manufacturing capabilities, has already started and it will kick into full gear in the new year. It's a $16 million investment that will happen over the next 24 months and is expected to yield 16% development yield, which is very healthy. Then the other items, which was post-year end, which we closed, was the phase 2 of our increase in our stake in Greer, which moved us from 26 to 35%, was completed in August, and phase 3, which is still available to us as Grit's option, which we would look to execute in the near future. And back to Bronwyn for the strategy.
Thanks, Leon. Thanks, Darren. So I think just to remind the audience, just to reiterate sort of our key focus areas, one around key principles and key activities. So again, our focus, you would have heard me say this concept of family of partnerships. And Leon did mention Standard Bank, who led the syndication now, and I'll make special mention of them at the end. But at the end of the day, our focus is on partnerships, key fundamental partnerships across Africa. We are here to service the real estate needs of multinational global tenants across Africa, whose businesses dictate that they have to be across the African continent, focusing on tenants and jurisdictions whereby we are able to secure hard currency leases, the diversification, country diversification, asset class diversification, north, west, east, SADC, Africa, key fundamental principle. And really that goes to what we've created around the real estate ecosystem effectively. And with the acquisition now of the APDM, which is the development manager, but what do? Ultimately, we obviously invest in real estate. The operational performance of the business has been strong. With the acquisition now of the development manager and Gateway, effectively now it's been able to service the needs of these tenants with regards to actually developing for them, the ability to leverage off the substantial platform that we've created on co-investment, the LR co-investment, the ability for others to co-invest alongside our operating model that we have now from really the entire value chain of real estate. And really around this is now, how do we take that value chain and how do we now go into the future with regards to developing smart business solutions, real estate business solutions, which become fee generative to the group, which we've already seen in our numbers today and which will have a huge impact on our numbers into the future. This for us is our key fundamental business model, which really is encapsulated around the following. What are we? We're a real estate owning business that services the needs of global tenants, and we've created this platform that can develop for tenants, that can own assets, that can property manage, facilities manage, lease, create other platforms or specific asset class platforms that others can co-invest in, really around this team of highly skilled professionals that we have put alongside ourselves to be able to service the needs of these global tenants across the African continent. And this really is our holistic solution to the real estate needs of our clients across Africa. As Leon mentioned, and as you would have heard me mention, and there's obviously been some significant press around this particular acquisition. So as you are aware, we originally owned 20% of this development management company. As Gateway has successfully closed and developed projects across Africa over the COVID period, focusing on impact real estate, American Embassy, healthcare, industrial, as has been showcased by the number of awards that they've taken recently. We've now completed the acquisition of phase 1 and phase 2 with the ability and optionality on phase 3. But this becomes part of the Grit Group, which means ultimately we are able to leverage off them as they are able to leverage off our asset management functionality. And ultimately, we're able to benefit from the NAV, and Leon mentioned it earlier, the significant NAV, net asset value upside we see into the future. And this timeline is really tremendous. There is no other developer across Africa that has delivered what this Greer team has delivered over the last 4 years and will continue to deliver into the future alongside our core fundamental partners in Greer. So we are very excited that we have closed and are closing, and that we are continuing with this development company into the future. So really just going into the last couple of slides. So 2 parts to our business which are absolutely core: total return, and obviously what makes up total return is the payment of dividends to our investors and the net asset value growth that we see today and into the future now going forward. So we are very proud to announce a 4.5 cent dividend, which ultimately implies just over 12.6% dividend yield on the current share price. That's a dollar dividend yield. And this business will continue to distribute out and will be targeting around 80% of distributable earnings. The total return, as we've mentioned, has historically focused on a 12% total return, moving up to 15% going forward around our delivery of these development projects under our Greer investment. And really just actually in closing, Darren, if you can just go through to the next slide. I mean, I think what's really been important is that we came to market in the midst of what we saw as a global pandemic. Africa, the globe, real estate was hugely impacted. We did not go to sleep as a management team. We committed to fundamentally looking at core focus areas, the operational performance of the business, historically and into the future, the management of the NOI, the management of the vacancies, the collections focus is a key priority for ourselves. ESG, focusing on our deliverables, remembering that we've now just raised $306 million under a sustainability-linked program. ESG, women-led, our carbon footprint, our ability to make an impact to the society and people of Africa is absolutely a focus area of ours. We've committed to recycling up to 20% of the current portfolio. This will be achieved in the up and coming months. The ability to use that cash to reduce LTV, to recycle assets, to recycle cash flow. The conclusion, as I've mentioned in the previous slide, of our development management company, the actual continuation and focus, and as you can see, Leon has spent a lot of time with our treasury team around the interest rate focus. We know what's happening in the globe. We see interest rates rising. We've been able to fix a huge portion of our portfolio, which is absolutely fundamental. And then the growth. We see significant growth under the Greer portfolio, the ability to launch these substructures, which will be something that becomes the market around the industrial substructure, the absolute management of obviously our cash flow. I mentioned our dividend, our payment of dividend. We had also alluded to the fact that we are looking at some form of buyback, which will be really important in relation to where our current share price is sitting, because we're very cognizant of the significant discount we trade to NAV. But really just to the audience, I mean, I think we are all aware of what is happening globally. So for us to be able to, one, achieve what we have, secondly, alongside key partners, this program, which is a first of its kind, the size of it for the sustainability-linked program that we've done with Standard Bank, with our other financiers, Absa and Nedbank, have been key partners. And we have got key partners in this business that have really strengthened our footprint across Africa and have given us a strong foundational platform for what is to come. So really on those notes and really just of where we've come to today, I really am, both Leon and I and the board of Grit and the management team, and actually to our incredible management team, who really has found the way over what we've seen as some very challenging market conditions to deliver this robust set of results. We're very proud to bring this to yourselves today. Thanks, Darren.
That's great. Bronwyn and Leon, thank you very much indeed for updating investors this morning. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. Just while Bronwyn and Leon take a few moments to review those questions that you've submitted already, I'd just like to remind you that the recording of this presentation, along with the copy of the slides and the published Q&A, can be accessed via your Investor Meet Company dashboard. Darren, if I may, you've had a number of questions from investors throughout today's presentation, so thank you firstly to you all for your engagement. If I may, Darren, just hand back to you to read out the questions and obviously host that, and I'll pick up from you at the end.
Thank you, Mark, and thank you to everybody for submitting questions. Feel free to add a few more in. I think what we'll do is start on one where we've seemed to have got a number of different questions around the same theme. So if I paraphrase, and I'll put this to both Bronwyn and Leon, it looks like the market undervalues our NAV and our current sort of intrinsic value. So, why do we think that's the case? What do we think we continue to need to prove to people for the market to recognize it? And how does that link in, please, with the share buyback that was announced this morning? And maybe I can ask with Leon to start, just to describe what we have what we've announced in terms of a buyback program and the size and sort of how it fills up the half-cent of dividend.
Thanks, Darren. Yes, I think one of the key items for the recovery of the share price is to start producing liquidity in the market. And liquidity breeds liquidity. And with us now having the ability to create some of this impetus in the market, we do see this as a positive impact on the share price. From a pure accountant point of view, this is probably one of the best investments we could actually conduct. We have put to the market that it's effectively going to be the equivalent of the half-cent distribution which we've held back, and this will be executed over the period of the next 6 months and should provide a very good underpin not only for the liquidity but also improvement in our reporting and results when we're looking at a per share analysis.
Yeah, and I think, Darren, just to go, I think this is a fundamental question. Ultimately, as management, we're significant holders in this business ourselves. So the share price and really just understanding the value that sits in the business today. If you remember, sort of just pre-COVID, we were trading at probably about a 5%, maybe an 8% discount to net asset value. And if we look what happened over COVID, I dramatically have said half our portfolio was boarded up. 25% of our portfolio is exposed to hospitality. The valuation, we are lost over $100 million worth of valuation due to the COVID impact, and sort of our LTV numbers ticked up quite substantially, which got close to covenants. And I think there was just so much uncertainty in the market. So we've had to really demonstrate and actually, I use this term, find the way to show the markets that one, hospitality has and can recover. And that is demonstrated in what we have collected significantly in the performance of our underlying tenants. We've had to reduce the LTV significantly. With the world, what's happening now, refinancing risk was a key risk component that was really highlighted in one of our key focus areas. So now us refinancing such a significant portion of our portfolio. So there's been a couple of really fundamental challenges that we've seen arise because of the global markets, because of the portfolio itself, because of COVID, that we've had to really demonstrate what can be done and what have we done. So, you can only hope with everything that's been done, the resumption of the dividends now, obviously the share buyback that we've announced into the market, the operational fundamental performance pre the dilution of the capital raise itself, demonstrating that valuations are valuations by the actual asset recycling program. So all of these are key fundamental aspects that we have proven in the last 12 months and will continue to do so in the portfolio going forward, which has to demonstrate that this business is hugely undervalued at the current share price versus what we see as the NAV of the business today. So that's really where we're sitting at the moment, Darren.
Thank you. And I think just to add some final clarifications, there's been a few questions about whether there'll be communiques. So please refer to the market announcements that were put out this morning. It does provide the framework of what we were doing on these share buybacks. I think the intention is not to go and be a wholesale buyer of Grit shares, but it's going to be a complement to the liquidity trading efforts of our market makers and sponsors in the UK. So there is detail there. The way these programs work is that the market makers will continue to trade, and Grit becomes a net buyer at certain points in time of their residual stakes. So, the intention is for this to support liquidity efforts, but at the same time demonstrating Grit's and the board's belief in the intrinsic value of the company. For further questions, please get in touch with investor relations or ir@grit.com, and we can take you through some of the details. I think let's maybe move over to drive and trade in. There's been a couple of questions about if you can just summarize what is provided for now, Leon, and what's not. Essentially, to what extent are there any further impacts to NAV in the future to be expected or not?
Sure. So the maximum liability sits at 17.5 million. To date, we have about 14.5 million provided in our books. As a reminder to everyone, the collapse of the structure obviously results in a number of the Grit shares that they own to hold as security, which will be brought back into the group effectively as a share buyback with a zero cost. So even though there may be a further write-down of $3.5 million or $3 million in total exposure, it does drop the share count by roughly $10 million, which does then result in a net uptick in our net asset value per share, as well as in the reduction of the shares that are for the dividends, which actually increases our dividend per share as well.
Great. This should be a quick one. Leon, to you, the high inflationary environment. Please, can you just summarize again how that links back to our escalation clauses and what sort of offset we get to rising interest rates?
So effectively, most of our US dollar-based leases have a component of US CPI. So we generally have a US CPI plus 2.5% in some cases. Some are a US PPI plus a margin. Obviously, some of the tenants would get to a situation where this might become unaffordable. We have in the past limited it to an amount just to ensure the sustainability of the tenants. But even with that in place, the actual escalations which we've seen coming through have still been very positive. A year ago, our weighted average lease escalation sat at about 3 to 3.5%, whereas now it's over 5.5%. And this is what we've been able to pass through to the tenants.
Perfect. Right, I'm going to combine a couple of different questions on this. In the past, we've spoken about various countries and the margins of safety.
Extend the leases like we did for...
Apologies, Leon. I lost you for a second there.
I think we've just waiting for the guys just to dial back in. It looks like we've just lost their connection. Just bear with me just 1 second, Darren, if you could. That'd be so kind. Thank you.
While we wait for them, I'll deal with one of the other questions, which was with the projected long-term rise in energy
Hi, Darren,
prices.
Can you hear us?
You're
Sorry.
back. There you go. Okay, you're back. I was just starting off by saying I'm packaging a few questions together here. So we've often spoken about margins of safety and entering countries where we can sort of get over certain hurdles of margins of safety. We have increased the number of countries we're operating in now. So can we just give a sense of what that strategy is? How do some of these new countries fit with that? And linking with some of the other questions of where do we see opportunities, both countries and sectors?
Darren, just to interrupt, I think Bronwyn needs to dial in.
Okay.
Yeah, they're just coming in now. Effectively, they got disconnected. So if you just bear with me just 1 second.
Put them on mute, Mark, and I'll deal with the energy side.
Go ahead, sir.
All right. So I think the other question was on terms of long-term sort of energy costs going up and the efficiencies in renewable energy sources. And what are our plans? Although we haven't announced anything yet, you can see in our sustainability-linked debt refinance, we have commitments in reducing electricity consumption, effectively carbon emission reduction. And so the group is committed to a 25% reduction by 2025 in carbon emissions from our assets. So I think there are lots of strategies, including solar and other renewable energy sources, that we are in the process of starting to implement in our buildings. Obviously, all our new buildings come with much higher ratings and designed in such a way to be green, as you can see in the Mauritius head office that we're building. So yeah, expect more announcements, but I think this is somewhere we're super passionate about, and I think you are going to see activity from us on renewable and solar energy. The other question we keep getting asked is, if you look at our tenant base, there is quite an exposure to oil and gas sector. I think, again, our growth in the other areas will dilute that over time. So they remain important clients of ours, but because of the way the portfolio grows over the couple of years, we will be diluting the exposure to oil and gas tenants, and increasingly our assets will be subjected to sustainability criteria and scorecards and improved carbon emissions.
Just to say, Darren, I believe we've got Bronwyn back in. Bronwyn, can you hear us?
Yes, apologies.
Perfect, no problem at all.
An opportune moment to be cut off.
Yes, indeed. All right, back to you, Darren. Thank you.
Great. So, Bronwyn, I'm going to package this question to you guys. There's a few different on the same thematic, but we've entered a couple of new countries. We have, and we talk about margins of safety when investing into countries. So, given these new countries we've got in the portfolio, how are we managing those risks? But secondly, and linking to another question is, well, where do we see opportunity? Other countries, other sectors, how do we see this playing out across Africa with opportunities to make returns for shareholders?
Yeah, thanks, Darren. So remembering some of the new countries we've obviously entered into has been through our associate partners, specifically the Gateway team. So the benefit of partnering, as I've always said, across Africa is that where people have got stabilized operations in these countries, the ability for us to co-invest or co-partner with them makes absolute sense. So yes, we have seen some new countries and new jurisdictions added to our territories. And again, those margins of safety still become and are absolutely relevant. So, land tenure, are we able to get our money out, the ability to debt finance, just general regulatory and political situations. So those still become absolutely paramount, and obviously the importance of the underlying tenant, the importance of the underlying lease. So through obviously the GRIA team or Gateway team, we have accessed additional territories. And for us, through this industrial substructure platform, we see a huge amount of opportunity in East Africa, driven specifically around Kenya itself. But again, our strategy is very much about servicing global tenants and being tenant-led. So provided that we are able to mitigate and have these margins of safety really dealt with in these jurisdictions, we are very much going to be led by our particular tenants and where they want to go. And also, again, Darren, it's our asset management functionality, our real estate asset management functionality, really around the property management, facilities management. I have to remind the audience that all of this is internally managed currently by Grit. We have a fully fledged operational team. So the strength of our people, localized people on the ground, really does give us further advantage in relation not to just to managing our assets, but managing assets of others. So we become the perfect co-investor partner for people wanting to access Africa, but that don't have a footprint to do so. So that really goes in light of our current territories, where we're going to, and really what the focus points into the future is going to be.
Great, thank you.
I think maybe just to add to Bronwyn's comment is, obviously the two territories which people will have a few question marks would be Mali and Ethiopia. And just to remind everyone that we do have the political risk insurance cover, which does cover our currency expropriation risk to get the cash flow out of the country. And maybe just to remind everyone as well that those two territories were entered specifically for the United States Embassy operations for their housing complexes, and we can lean on them and their relationships to ensure that those operations are running smoothly.
And just a final overlay, in Nigeria, the data center sits in a special economic zone. So where people have worries about currency repatriation, those SEZs do provide an element of protection to the group.
And trade completely in US dollars.
Yeah,
absolutely.
100%.
Absolutely. Right. I'm going to package a couple different questions together here for you guys. I think it's really, Leon, some indication of where you believe LTV settles. And I think if you look at some of the capital commitments, specifically Greer Phase 3, but I think offset by our asset recycling strategy, and therefore the longevity of the dividend. So I think it's sort of those couple of topics all form part of the same discussion. As what is the guidance now for our LTV over the medium term? Do any of these upcoming capital commitments have a significant negative impact on your LTV? And to what extent and what other activities and actions are you taking place to offset those, including obviously the acquisition and consolidation of Greer? So how do those moving parts come together?
Sure. I think the net point on the phase 3 or the final push for the acquisition of Greer, taking us to a controlling stake, is effectively on a net basis going to increase or decrease the LTV by 4 basis points, so 4%. That still remains in place. The key concepts that we need to manage over the period of time is cash flows. The sustainability of the cash flows. When you look at our leasing income, we've got a 4.8 year weighted average lease expiry. Leasing is actually ahead of schedule in terms of where we originally thought, specifically buoyed by the retail sector. And having the protection that these interest rate hedges put in place does give us a lot of comfort that the sustainability of the cash flows will remain. Obviously, the asset recycling, putting the cash from the asset so that are going to be sold back into either debt in the interim period before we actually reinvest them into more accretive projects, does provide a very good underpin in terms of reducing costs and cash flow items over those periods of time.
Great, thank you. And then maybe we can just go back to the dividend guidance. I think previously we'd sort of been talking over 5 cents a share going forward. Maybe you can give us some thoughts about the sustainability of the dividend and maybe some of the potential impacts that interest rate hikes might have brought onto sort of prior guidance.
Sure. So I think the guidance that we provided between 4.5 and 5.5 cents is actually sustainable with regards to the certainty of the cash flows, as mentioned before, as well as the hedging products which we've got to provide a more solid base for predicting cash flows in a very difficult interest rate environment. Does provide a significant underpinning to the cash flows and the sustainability of these dividends going forward.
Yeah, and obviously as other income producing assets come into the base over the next 18 months, that further increases the cash generation. Maybe linked to that, Leon.
Darren, maybe just to link to that, I mean, I think I've touched on it today. We do see the fee generation side of our business really becoming a very important part. And that's really around really just monetizing the IP that we've created across Africa in our various sort of different platforms. So, and we've already seen it. So we've already seen it in the numbers of asset management fees coming from co-investment already, and we see that as a huge opportunity from a cash flow perspective and fee generation perspective too.
Yeah, if we can, maybe we should pause there because there are a couple of questions coming through on what APDM could produce us and various other fee generating units. So maybe, Leon, if you can just talk to that corporate line a little bit and maybe give a sense of, not giving guidance, but essentially how we're thinking about that fee generating unit, please.
Yeah. So if we look at the actual Greer or APDM team and the amount of developments that they could roll out in any specific period of time, under the current capacity, they could be doing a rollout of between 180 and $250 million of developments in any 12-month period. And when you consider that the normal fees for development managers rates between 4 and 5%, I'll leave it up to the audience to actually make their own assumptions on that. Obviously, the next year following January's completion of the hospital in Mauritius, there's only 2 other projects currently taken up by the team, which does give a lot of capacity for taking on further developments, either internally or through co-investment opportunities or even externally completely.
And I think just to overlay, I think in our numbers, it's not very easy to see where they come through, just the way IFRS forces you to account. which is why on these revenue and NOI sort of bridges that we provide, that corporate line is the one that you will see start growing. And the fee income line will come through as again, we'll probably get into the detail, but you can get a sense there for the couple of months that we've had it in for the year. We've seen a strong acceleration in revenue in the corporate line, which is obviously expected to annualize over time and increase as we roll out further fee income generating units. I think we've only got time for one last question. So let me pose this straight back to you quickly on the euro exposure. Can you just give us some insight into what the residual risk is and how do you get a residual euro exposure?
Certainly. So when we look at our total euro asset base versus our total euro debt base, where we have a sort of natural hedge in place on that, we've got an open position there of $73 million worth. The hedging products which we've just entered into now, which is a cross-currency swap in terms of the interest rates for a notional amount of 25 million, brings that down considerably. And then just looking at the funding structures we have in place for Cape Skirring, which is going to be effectively debt funded, it further reduces that net exposure position in terms of those assets versus the liabilities. Contrary to what you would normally think is a negative move against the euro to the dollar, actually has a positive impact to our LTV covenants and ratios, because the euro assets have historically been at a higher gearing level in order to achieve this natural hedge that can come in place by having a better match in terms of your euro versus dollar asset open position.
Great. I think with that, we'll probably hand back over to you, Mark.
That's great, Darren. Thank you very much indeed for hosting that, and Bronwyn and Leon for your engagement this morning. I know investor feedback is particularly important to you both, Bronwyn and Leon, and I'll shortly redirect those on the call to give you their thoughts and expectations. But I wonder, before doing so, if I may, Bronwyn, just hand back to you just for a few closing comments, and then I'll send investors to give you their feedback.
Yeah, thanks, Mark, and thanks for hosting us today. So I think, just some closing comments is really, it's the importance about, really delivering a solid set of robust results today, which has been key. But it's not just about what we present today, it's about what we're going to be focusing on to the future. So as I mentioned earlier, we have created a really, really strong foundational platform now to really leverage off the very, very difficult climate we've come off in the last sort of 2 years. And what the team has been able to achieve in creating that foundation really just solidifies what we were able to do going forward. So we really are very excited for what's to come, and really what's going to be up and coming in the next 12 months, and really around solidifying our relationship with our development management company, seeing what they're able to deliver and closing those projects, and really just around the focal points around the balance sheet side of the business, stabilizing the operations, a continuation of strong operational performance, which is fundamental to the business, and really just delivering on what we said we're going to do, as we have done over the last couple of months. So, Mark, and thank you, Darren, on your side, and obviously Leon, really on that note, we are really, really happy to present these set of results to our key stakeholders, and just a final thanks and gratitude to our partners. Really, without the likes of Standard Bank and some of our key fundamental partners, including our auditors, PwC, they've been fundamental pillars in delivering what we have over the last couple of months, and there are a number of others out there. I say we are a family of partnerships, and we ultimately find the way, and that's ultimately who we are as Grit. So on that note, Mark, thanks very much.
That's great,
Thanks, everyone.
That's great. Bronwyn, Leon, Darren, thank you very much indeed for your time this morning and for updating investors. Can I please ask investors on this call not to close this session, as we'll now automatically redirect you for the opportunity to provide your feedback in order the management team can better understand your views and expectations. This may take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Grit Real Estate Income Group, I'd like to thank you for attending today's presentation. Good morning to you all.